Hello, finance friends. In this lecture, we're going to move forward into our How You Use Money Well bucket, and we're going to discuss today and in our next couple discussions, taxes. We're going to start with the lecture today on just the top level, kind of broad basics of tax planning and what the federal tax code means and the way that taxes work conceptually. And then in a separate video, we'll introduce a fictitious character named John Doe. And with John Doe, I will give you some fake information and some made up forms on him. And together we'll construct a tax return. Doing that will, number one, teach you how to do a tax return. And number two, once you understand the mechanics of how taxes actually work and how a tax return is completed, the conclusions from today's lecture on ways that you can minimize your tax burden will make a lot more sense. Okay, so let's jump into it. So at the top level, let's talk about tax planning in context. Now, in a previous lecture, we had said that when we were talking about houses and mortgages, that for most Americans, the cost of their home and their mortgage is the biggest single outlay that they'll make in their whole life. And you had to be really prudent about those decisions. Well, I would say that a close second to housing costs for most Americans are going to be your tax burdens. If you treat taxes as a cash outlay, like I've taught you to do in a previous lecture on your cash flow statement, remember, taxes that you pay, they're just an outlay that you make, and it's the price of being a citizen. So if you put it in that context, taxes are right up there with your house purchase and your mortgage, as for most Americans, one of either the first or the second largest expenditures that you'll make in your lifetime. Now, it may not seem like that much because you're having a little bit of tax taken out of every paycheck, and that's going to add up over the course of weeks and months and years and decades. But on the big picture, you'll be spending a lot of money on taxes. And for that reason, one of the basic principles of personal finance is that you understand how taxes work. You understand some key principles that can help you to be smarter with your taxes, plan effectively, avoid dumb errors, and legally minimize your tax burden. So it's important to start off by understanding that in modern life, you're going to be paying lots of taxes, and you'll be paying lots of taxes in lots of different ways. Obviously, you're going to be paying taxes on purchases. Those are called sales taxes. And if you ever own property, if you ever own property, you'll be paying property taxes. Now, whether you buy anything or not, or you own property or not, if you have a job, you are also going to be paying income taxes. And that's really the focus of this lecture today. We're really going to focus on income taxes. Now that we've talked about all the taxes that you're going to pay, let's drill down to income taxes. And you're going to be paying several types of income tax. It's very important that you understand that while a lot of people say the word taxes broadly and they use it to mean everything, you're actually going to be paying several different types of taxes. They'll be taxed at different ways, and they'll be taxed at different rates based on your income. So it's really critical that you bear in mind that for most of you, you'll be paying, when it comes to the income tax equation, you'll be paying either 2 or 3 primary forms of income tax. Now, the first one that you'll all have to pay, this is federal income taxes. Federal income taxes, these, first of all, are filled out on Form 1040. And these are the taxes that are collected by the U.S. federal government. And it's important to note that these taxes, they're going to be applied to all the income that you earn. The source of the income doesn't matter. Now, there's a few minor exceptions, but the reality is at the U.S. federal level, all your income from all sources is going to be taxed. And that's going to be done on a Form 1040. In addition, in almost all of the United States, in all the states in the USA, in fact, I believe it's currently 42 states. I think there's 8 states that don't have it. But in the vast majority of the states, you're also going to be paying state income taxes. Your state income tax form in California, this is your Form 540, But no matter what state you're in, your state tax form is basically a derivative of your federal tax form. You do your federal taxes first, get those all sorted out, and then you transfer those numbers over to the state level, make a few refinements based on individual state law, and then you're done there. So again, it's important to bear in mind that much like your federal income taxes, your state income taxes will also apply to all income earned. Now, there is a third type of tax, and this one, which is paid by most Americans who work, not all, but most Americans who work, these are known as payroll taxes. Now, these go by many, many different names. It can be seen as very confusing. So payroll taxes, they're also called FICA taxes, or they're called Social Security taxes. They're sometimes called Medicare taxes, and they sometimes are called by their technical name, OASDI taxes. That stands for the Old Age, Survivors, and Disability Insurance. Basically, payroll taxes, these are the taxes that all workers who are currently working pay in order to fund America's Social Security program. So FICA was the law that set it up. Social Security and Medicare are the two types of individual taxes, and OASDI is the technical name. So all these terms are used interchangeably. So that's your third type of tax. Now, a couple of subtleties here. Subtlety number one, whereas your federal taxes and your state taxes were levied on all of your income made, FICA taxes, they're called payroll taxes for a reason. They are only assessed on your wages and salaries. They do not apply to any other type of income. So your payroll taxes are only levied against your income, generally from salaries or wages. Within FICA, there's a couple of subtle other distinctions. So FICA technically has two distinct components. Component number one is the Social Security tax, and component number two is the Medicare tax. Now, for most people, they're just combined together into one big tax, but the reality is, the way the law is structured, the FICA taxes have two distinct components, Social Security and Medicare. Here's the distinctions. Number one, on the Social Security tax, this is leveled at 6.2%. So the Social Security tax is 6.2% of your taxable gross wages. Now, another subtlety of the Social Security tax is it is 6.2%, but there is a maximum upper threshold. So basically what we're going to say is the Social Security tax is 6.2% of your gross wages, but only up to a maximum of $168,600. What does this mean? Well, it means that if you make $100,000, then your entire $100,000 salary is hit with the 6.2% SS tax. If you make $168,000, the entire $168,000 is leveled at 6.2% SS tax. But let's say that you made a salary of $200,000. You only pay 6.2% on the amount up to $168,600. Anything above that level has no SS tax on it. This means that in 2024, your maximum SS tax is going to be $10,453.20. That's 6.2% of $168,600. Now, this is for 2024. Every year, the US government ratchets up that threshold based on inflation and other factors. So for 2024, it's $168,600. It's expected to rise by a few percentage points every year. That's the first one, the SS tax. The second is the Medicare tax. The Medicare tax is 1.45% of your gross wages. Now, it's a lower tax, but here's the kicker. The Medicare tax has no maximum limit. In other words, there's no upper floor. If you make $1,000 a year, $100,000 a year, 10 million a year, or 100 million a year in wages, that entire amount is hit at 1.45%. So those are the two types of taxes that make up your Medicare, Social Security, FICA, whatever you call them, taxes. Note that together it's 6.2 and 1.45%. So collectively, these taxes equal 7.65% of your income. And that's in addition, this is important to say, it's important to bear in mind that 7.65% is separate from your federal taxes and your state taxes. So if, for example, like me, you live in California, you're going to be paying 7.65% of your income to FICA and an additional amount to the federal government and an additional amount to the state of California. So you can see how these things will add up really quickly. There is one more thing I want to point out to you. There is an additional tax when it comes to your payroll taxes that is known as the additional Medicare tax. This tax is levied on high income earners. So if you're what we would call a high wage earner, in addition to your Social Security and Medicare taxes, you're also going to pay an additional tax, the additional Medicare tax. This tax is going to equal 0.9% of every dollar that you earn above a particular threshold. That threshold currently sits at $200,000 for single filers, $200,000 for head of household filers, and $250,000 if you're filing taxes married filing jointly. What does this mean? Well, if you earn $190,000, you pay no additional Medicare tax. If you earn $205,000, then the amount of your income above $200,000 is $5,000. That's leveled at an additional 0.9%. So those are your three types of taxes that are related to income. I'll point out one other thing, which isn't super important, but you need to know it. Technically, under the way that the FICA laws are written, you pay a portion, half of your total FICA tax, and your employer matches the other part. So technically, you are paying 7.65% of your wages as the employee portion, and your employer is also paying 7.65% as the employer contribution. So technically, if you think about it, FICA is actually 15.3% of your wages. Now you're thinking that's not a big deal, but if you're ever going to consider being self-employed, it is a big deal. Because by definition, if you are self-employed, you are not only the employee, but you're the employer. You're the boss and the worker. So if you ever were to go, I lost my share screen there. Let me get that back up. Sorry about that. Give me 1 second. Okay, I think we're back. Let's see if we can pull it up. There we go. Okay, we're back. So if you're ever self-employed, you're going to have to not only do your own personal taxes, but an additional tax form, because you're going to be on the hook for an additional 7.65%. A little word to the wise, if you ever do decide to become self-employed, you need to remember this additional tax burden right here. This additional tax burden right here when you set your prices. One of the biggest errors that first-time entrepreneurs make is they set their prices and they don't account for the full extent of their tax burden. And within a year, they're really, really being squeezed in cash flow. That's dangerous. So anyway, those are the types of taxes that you pay. So make sure you understand them, understand how they work, and there you go. Now, moving forward, it's important to understand that through the lens of economic theory, taxes can be classified as either progressive or regressive. What does this mean? Well, a progressive tax means this. With the progressive tax, as your income goes up, you pay a higher percentage tax. And a regressive tax means that as your income goes up, you actually pay, sorry, undo that. You actually pay a lower percent tax. Now you're asking, what does that mean? Well, by percent tax, what we mean is the amount of tax that you pay in dollars divided by your income. In other words, progressive taxes mean higher income earners pay a higher rate, a higher percentage rate of tax. A regressive tax means that higher income earners pay a lower rate of tax. Now, there's some subtlety there, and we can explain it later, but just know that for now. It's especially important to see this within the context of political discussions. You'll oftentimes hear our politicians say that a particular tax helps the rich or hurts the rich or helps the poor or hurts the poor. What they mean is that the tax is either progressive or regressive. In other words, progressive taxes hit the wealthier harder. Regressive taxes hit lower income people harder. Now, why do I bring this up? Well, here's why. From a strict perspective, numbers 1 and 2, your federal and state income taxes are structured to be progressive. On the other hand, that payroll FICA tax is by definition regressive. So it's important that you kind of understand that these 3 different types of taxes behave in subtly different ways, and that you can connect that with some of the political discussion around whether a tax is progressive or regressive. Another point, we know that we have to pay taxes. The question then is, how do we pay taxes? And taxes can be paid in several ways. Sometimes, as in the case with sales taxes, when you purchase an item, the tax is simply added to the price of the item and you pay it at the time of the transaction. Sometimes, with things like property taxes, you send the tax in periodically, maybe every year, maybe every 6 months. When it comes to income taxes, for most workers, your taxes are taken out by your boss directly from your paycheck automatically. So the third way that we can have taxes paid is by automatic withholding. This is the case for most people when it comes to their income taxes. If you've worked, you know that you'll get a paycheck and there'll be on your pay stub an amount that you earned gross, any taxes taken out automatically, and then the amount that you clear, the difference, which is called the net. The federal government does this. In fact, they mandate that bosses automatically withhold for 2 reasons, really. Reason number 1 is they want to make sure that they collect their taxes. And therefore, the easiest way is to take a little bit out of your check every check, as opposed to waiting on you to send in a big amount at the end of the year. The other reason why they insist on this is because the federal government, when they withhold money every check, they actually can earn interest on that money. So they also maximize their interest earned by having more access to more of your tax dollars more often. The fourth way, which is also related to income taxes, it's usually the case that this is done by self-employed workers, but the fourth case is when a worker sends in an estimated payment. Again, this is often done by entrepreneurs. Since think about if you were an entrepreneur. Well, you don't really have a traditional boss who's going to withhold money from your check. So you're going to be earning income, earning some profits in your business in order to account for your tax burden, since there's no withholding, 4 times a year. Quarterly, you're just going to make an estimate of how much tax you owe based on the income that you had in that quarter, and then you send it in on your own. Okay, so that's that. 2 final points about taxes. Let's talk about the calendar and the timing. First things first, for most taxpayers, the tax year So we're going to call this the tax year. It's just the same as the calendar year. Starts on January 1st, ends on December 31st. Nice and easy. What this means then is that any income that you make within a calendar year is reported and taxed on that calendar year's tax return. Now, that tax return and any amounts that are due must be filed by April 15th in the following year. So, for example, if this year, let's say that this today is May of 2024. So if this year, calendar year spans January 1st, 2024 to December 31st, 2024, any income that you make in this calendar year has to be put on your 2024 taxes. Those 2024 taxes must then be prepared and filed by April 15th of 2025. So the government gives you about 3.5 months to get all your paperwork together at the end of a year, get yourself organized, get your taxes prepared, get them filed, and again, if you owe anything, pay what you owe. Okay? So that's the big picture. Now, let's move now down into a bit of a more technical thing. We have to drill down. We're talking now in this slide about what are called marginal tax rates and effective tax rates. Now, these are really important terms. Let's talk them through. Your marginal tax rate, this is a technical term. This is the tax rate that applies to the last dollar of income that you earned. In economic principles, the word marginal means additional or next. So for every additional dollar you make, in other words, the last dollar that you made or the next dollar that you will make, the income tax rate that dollar is taxed at is known as your marginal tax rate. This is one of the most important ideas in tax theory. On the other hand, your effective tax rate, this is basically the total amount of taxes that you pay divided by your income. So the marginal tax rate tells you, given your income that you have right now, if you earned an additional dollar, how much tax would you pay on it? And the effective tax rate tells you, in a given year, how much tax did you pay divided by what was your income? Okay? Marginal tax rates, they are found on a tax table. We're going to look at that in a moment, and you'll see how it works. So just know that in any given year, for either the federal government or for the states, you can always do a quick search online and find what's called a tax table. And that tax table will show you the marginal tax rates. The other thing to point out is that by definition, mathematically, your marginal tax rate will always be higher than your effective tax rate. Because your marginal tax rate is again, it's a progressive system. It's the higher tax rate that you pay on your next dollar earned. Your effective tax rate blends in parts of your salary that were taxed at lower rates. Now, this sounds confusing, so let's look at our current federal and California tax brackets. And once you see it, it'll make more sense. This right here for the year 2024 is the federal income tax brackets. Okay, let's take a couple of looks. Let's take a look and dissect a couple of things here. First thing you see here are the tax rates. We currently have in America 7 different tax rates: 10%, 12%, 22, 24, 32, 35, and a top marginal rate of 37%. The next thing you'll see is that we have here the 3 main filing statuses. In tax law, you typically file in one of 3 statuses. Single, meaning you're not married. Married filing joint, meaning that you are in fact married and that you and your spouse combine your materials together to file a joint return for the family unit. And then a unique one called head of household. Head of household is a status That is for people who are not married, but have another person besides themselves that they provide care for, typically a child or a parent. Okay, so again, you see your single, your MFJ, married filing joint, or your HOH, head of household statuses. And then what you can see, so let's just go to here, I'll just show it, is that within each of the statuses, single, married, or head of household, you have basically brackets, upper and lower levels. So let's isolate and let's just focus for now on single. So we're just going to focus on this right here. Well, what does this tell us? Well, let's suppose that you're a single filer and that you have an income of $100,000. Well, $100,000 puts you in that bracket because 100,000 is between 47,150 at the low end and 100,525 at the upper end. And as long as you're in that bracket, what we call that marginal bracket, or what we would specifically call the 22% bracket, as long as you're in that bracket, each additional dollar of income that you earn will be taxed at 22%. Notice that not every dollar you earn is taxed at that rate. In fact, your lower levels of income, your first $11,600, for example, are only taxed at 10%, and then your next chunk or bracket of money is taxed at 12%. So it's important to note that, again, in my example, you're making $100,000, you're in the 22% tax bracket, but you are not paying 22% on all of your income, only on the portion that falls in that bracket, okay? So that's a very, very important concept, and it's one that a lot of people misunderstand. But it's important for decisions like, should you work overtime? So, or let's say that you work and you're in the 22% tax bracket. It's important to know your tax bracket because if you have to decide, should I work overtime? Should I take on a second job? Or imagine a couple that's married. One of the partners stays home, let's say to raise children, but eventually that partner wants to go back and work. It's important that that family knows what's our marginal tax bracket, because when the partner who's coming back to work comes back to work, their income is going to be taxed at that marginal rate. So this is the way it goes. You'll notice that I also put in the notes for this lecture a quick handout on how tax brackets work. And I guess maybe the best way to do it, you can read through this, but maybe with two examples. And again, up here, once again, I explain the marginal tax rate and the effective tax rate. So let's do a quick example. Example 1, you're a single filer, you have an income of $30,000. So single and 30,000 puts you right in here. So obviously, you're in the 12% bracket. Now the question is, are you taxed at 12% on your whole income? And the answer is no. Instead, it looks something like this. I want you to imagine that you have 0. Let's go back to our bracket. Our first bracket was 0 to 11,600. So from 0 to 11,600, this amount is taxed at 10%. So this would, of course, be $11,600 multiplied by, we said again, 10%, or that's 1,160. But now, you're making $30,000. So the 30,000 is up here. And this 30,000, again, to put you in that bracket, this is going to be taxed. So again, this was here taxed at 10%. This is going to be taxed at 12%. Well, what does that mean? Well, since the 12% bracket starts at 11,600, then 30,000 minus 11,600 is 18,400. It is that 18,400 that is taxed at 12%. Again, the whole 30,000 is not taxed at 12%, just the marginal or additional income above, in this case, 11,600. 18,400 times 0.12 is 2208. And therefore, you have $1,160 in this bucket, 2208 of tax in this bucket or bracket, and therefore together your total tax is 3368. That's how much tax you're liable for. Notice if you wanted to calculate your effective tax rate, your effective tax rate is like a blended tax rate. It's the division of all your tax paid divided by all your income earned. So your effective tax rate in this case would be equal to 3368. That comes from there, divided by the income we said of 30,000, or that's going to be 11.22%. So you have a marginal tax rate of 12%, but an effective tax rate of 11.22. Again, the marginal rate will always be higher than the effective rate because by definition, the effective rate is going to have some of the lower taxed money in it. Let's move on and do a second example just to make sure we get it. Now you get a raise. Good job for you. So now your income is $50,000. You can see here that at an income of $50,000, this now puts you in this bracket, or 22%. So obviously 50,000 puts you in the 22% bracket. But again, does this mean that, now you're paying 22% on all your money? Well, the answer is no. If that were the case, you would lose money, but it's not the way. Instead, it works out like this. We have 0 to 11,600. And then we have 11,600 to 47,150. And then you're earning 50. So we have here like three different chunks, three different brackets, or three different buckets of money. And this first one's going to be taxed at 10%, and then 12, and then 22%. So this means that 11,600 will be taxed at 10%. So that's going to be 1160. Here, 47,150 minus 11,600, that's going to be 35,550, and that'll be taxed at 12%, and that's going to be 4,266. And then up on top, you have 50,000, because you got that raise, minus 47,150. This means that you're going to have 2,850 multiplied by the rate of 22%, and that's going to be 627. You add all those up, your overall tax liability is going to be 6053. But again, your effective tax rate is only going to be 6053 divided by 50,000, or 12.11%. So that, my friends, is how the marginal tax bracket works. Having a bit of a delay here, so hopefully these slides come back up. Let's see if we can get it. Okay, we'll get back to it. So that's our marginal rates, okay? If you have any questions, send me a note and we'll figure it out from there. Now that we understand those big ideas, now we can really get to what we mean by, we say, effective tax planning. Sorry about that. We seem to have lost that again. So let me try to get this going. There we go. My apologies for that. Looks like our Good Notes program is rebooting. There we go. So why do I bring up all these big picture concepts? Well, because ultimately there are three goals, as it were, when it comes to tax planning. The goals of tax planning are to, and I stress the word legally, we'll get to that in a minute. The goals of tax planning are to legally either reduce, eliminate, or defer as much of your tax as possible. Either pay less right now, pay none at all right now, or push any tax that you have to pay forward as far forward as you can. Okay? But again, we have to stress that you have to do this legally. The IRS has no patience and they will fine you if you break laws. To help underscore that, in tax planning theory, we distinguish between what we call tax avoidance, which is legal and prudent, and I would even say it's your obligation as a citizen. People may disagree, but my view is, as a citizen, it is your obligation to pay the amount of tax that you owe legally and not a penny more. Okay, so that's tax avoidance. You should do it. On the other hand, you do not do tax evasion. That means that you are committing some type of fraud. You're getting involved in some weird scheme. You're doing something illegal. It could be concealing income or inflating expenses or using bogus tax shelters in order to illegally avoid your obligations. Okay, so tax avoidance, legal, do it. Tax evasion, highly illegal, you go to jail, don't do it. Okay, so that's what our goals are. When it comes to doing taxes, taxes are done in America at the federal level on a form called a Form 1040. Okay, so the Form 1040, this is the tax form that is used by all citizens and anybody else earning income here in order to report and pay taxes on the income that you make. Again, the IRS Form 1040, this is for your federal taxes. Depending on what state you live in, you may have to pay state taxes and you'll have your own state form. But I want to focus right now on federal taxes and the structure of the 1040. So let me try to find, I have a 1040 form that I'd like to show you. Here it is. This is posted with the lecture materials. This is the most recent tax form we have. You'll see on this that up here on top, you see it's the form, it's the Form 1040 for 2023. And all this stuff up here is sort of like background information to help the tax return go. Personal information, your name and your address and your social. You indicate right here your filing status. You're required to tell the IRS if you own any sort of digital assets like cryptocurrency. And then if you have any children that you're claiming, you claim your dependents here. So all those things go on top. That's fine. But the real kind of heart and soul of a tax return begins right here. Okay, so let's go through this and let's try to make some sense of the different lines in a tax return. And I would offer to you that in a traditional tax return, while everything's important, there's 5 key lines that sort of dictate what's going on. The first one of those, total income on line 9. So that's right here. Total income on line 9. Notice that line 9, your total income, that this adds up everything else up here. In other words, we said before that at the federal level, you're going to pay taxes on all the income that you make. And you can see in all of these lines here, all the different types of income that we're talking about: wage income, interest income, dividend income, capital gain income, Social Security or pension income, all kinds of incomes. Okay, those are added together, and line 9 shows your total income. The second most important one is your adjusted gross income on line 11. So let's go and look here. Your adjusted gross income is on line 11. Here's the thing you have to understand. It's very important you get this. You are not taxed at the federal level. You are not taxed on all of the income. Okay, you're taxed on all of the income that you earn. But what the tax return does is it takes you through a systematic process to sort of legally chip away and reduce the amount that you're taxed on. So the first step is to add all of your income together and get total income on line 9. From there, you're entitled to what are called adjustments or subtractions. Those adjustments or subtractions come from Schedule 1, line 26, which I'll show you in a separate video, and they sort of feed into this form here. You subtract those subtractions from your total income, and you get your adjusted gross income. The third one, and this is the really important one, is your taxable income. Your taxable income is on line 15 of your tax return. So we'll go here to green, and you can see here that it's on line 15, which means that it takes into account these lines here. Here's the idea. All taxpayers have a chance to take a deduction. That deduction can either be an itemized deduction on a Schedule A or a standard deduction that every taxpayer is entitled to. You have to go through the hard work of figuring out which one is the biggest, but you take the biggest. Notice that line 11 was your adjusted gross income. You then either take on line 12 your standard deduction or your itemized, and there's a few other adjustment lines here, but you subtract that and you get line 15, your taxable income. So in other words, if you think about it, all of your income is total income. That's chipped down and reduced to your adjusted gross income, and that's chipped down and reduced to your taxable income. The taxable income, this is the number that determines the tax that you pay. And therefore, one of your goals in tax planning is to legally reduce your taxable income. Obviously, you reduce your taxable income by maximizing your adjustments, by maximizing your deductions, and by taking any legal steps, which I'll show you later, to reduce legally your total income. Okay? But we've now gone from total income to adjusted gross income down to taxable income. Now, if you notice your taxable income on line 16, this becomes the basis for line 24, your total tax. This is the fourth important line, your total tax, the amount of tax that you are accounted for. Sorry, I should say the amount of tax that you are accountable for, the amount of tax that you are liable to pay. Your total tax, we should point out, is a function of your taxable income and your filing status. So the goal is you legally reduce your taxable income, which then legally reduces your tax burden. That's line 4, total tax. And then your final one is line 33, and line 33 are your total payments. So if you think about it, lines 1 through 9 show you your income. Lines 10 and 11 reduce it. Lines 12 through 15 reduce it even more. Line 15 is your taxable income. That's the basis for any tax that you owe and your total tax. And then you have payments that you're making, generally through your boss's withholding. Those are your payments. And once you have those, then you're done. Because at the big level, if you really think about it, a lot of people get really confused about tax returns. It's really not that difficult. At the big picture level, I want you to think about your income tax return as simply being a balancing document. Basically, the government uses your tax return so that every year you can clear the slate. They want to get you to a zero balance. That's the goal of a tax return, to get you to a zero balance with the government. Therefore, as we said a moment ago, the tax return really compares these two numbers: the total amount of tax that you're liable for, the total amount that you have paid. The total amount that you're liable for, the total amount that you've paid. If you think about it, every form, every schedule, every calculation on any tax return is just designed to figure out two numbers. How much tax were you on the hook for? And how much payments did you actually make? And here's the way it works. If the tax that you paid is greater than your tax liability, in other words, if you had more money withheld than you owed, then the government owes you money. And you get that money, that difference, via a refund. So if you owed a liability of $1,000 and they withheld $1,400, you had $400 too much withheld. You get that back as a refund. Your slate is cleared. Your balance is zero. On the other hand, sometimes it works out the other way. Sometimes your tax paid is actually less than your liability. So let's say that you had a tax liability of $2,000, but you only had $1,500 withheld. Well, in that case, you did not kick in enough money. You owe the government the difference, and you're going to pay that difference by April 15th to, again, pay the difference, clear the slate, and get your balance to zero. So don't get overly worried about it. You're just looking at a systematic way. That's all a tax return is. It's a systematic way to drill down, figure out your taxable income. From there, your tax owed. From there, the tax that you paid, and then the difference of those last two numbers. And that's the big picture. Just to recap this, we just said it, but I'll do it one more time. The first key number, the amount of tax that you're liable for, this is a function of your filing status and your taxable income. Now, again, I want to stress that we have very specific terms in tax. Taxable income has a very specific meaning. It is not the total income that you earned. It is not the total income that you earned, because your taxable income is way down here. So it takes all of your total income and subtracts your adjustments and subtracts your deductions. What this means is that hypothetically, you could make $100,000 in income this year, but maybe only have $80,000 as taxable income. It is very common, if you structure your tax affairs correctly, it is very common if you structure your tax affairs correctly to have a taxable income that is far lower than your actual income. And that's a good thing, because again, taxable income, this is the basis for your tax liability. As I said a moment ago, all a tax return is a process to systematically move from total income to adjusted gross income to taxable income. Step by step by step, every step, chipping a little bit away, reducing income, chipping a little bit away, reducing income. Okay? Your total income, which is the amount that you made, that's the sum of all your income during the year. But again, total income is not the same as taxable income. Again, because total income is way up here, taxable income has had some adjustments and deductions made to it to reduce it down. Okay? But I bring up now total income because the total income is for most people. Now, there's a handful, generally the wealthy and the elite, who make the bulk of their income on dividends or interest or trust fund distributions. But for the vast majority, for the vast majority of Americans, the largest source of income is their wage income. And this is, this wage income, the money earned from their jobs, this is reported on a form called a W-2. And if any of you have worked, you know that a W-2 is a form that your boss sends you every year to summarize all the activity of the previous year. A W-2 summarizes your wage and salary information. That's one thing. It summarizes your federal, state, and payroll taxes withheld. That's the second thing it does. And because tax law is very confusing and there's lots of weird ways that you can structure your affairs, the W-2 also provides supplementary information to help you make sense of your income or help your accountant make sense of your income when you do your taxes, okay? So the W-2 will summarize, number one, how much money you actually made. Number two, how much federal, state, and payroll taxes were withheld. And number three, any supplementary information. And it does this through a series of boxes. A W-2 has a series of boxes and they're numbered, box 1, box 2, box 3, box 4, etc. And each of these boxes indicates a particular number with a particular meaning. Specifically, boxes 3 and 5 show the total wages paid by your employer and subject to SS and Medicare taxes. Box 3 shows your SS tax base. Box 5 shows your Medicare tax base. Boxes 4 and 6 are also tied to SS and Medicare. Whereas boxes 3 and 5 indicate your basis, your income basis for those taxes, boxes 4 and 6 actually indicate how much taxes were actually withheld for those. Those are very important for your long-term future and for your Social Security future. But when it comes to an income tax return, the really important ones are boxes 1 and box 2. Box 1 shows the total taxable income that you earned that is subject to tax. In other words, how much money did you earn that, how much money did you earn that has to be reported to the federal government? Because the amount on box 1 transfers to your Form 1040. Take a look. Let's go back up here. Box 1A, total amount from Form W-2 box 1, it transfers right there. So for most Americans whose income comes primarily from work, the number on box 1A, which again comes right from your W-2, that's going to be the bulk of their income, okay? When you're doing your own taxes and you have to figure out what actually goes in that box on my, you're doing your tax, you say, what do I actually put in this box? Well, the answer is you put whatever number was in box 1 of your W-2. Now, box 2, whereas box 1 shows the income basis that's going to be reported, box 2 shows the total federal taxes that your employer withheld on your behalf. And that's going to transfer right here. Under payments, box 25A, federal tax withheld from Form W-2. That will go right there and will end up transferring here. What does this mean? Well, it just means what we already said. Box 1 of your W-2 is what influences your taxable income and therefore influences your tax due. Box 2 shows how much money has been withheld. It's a balancing document. How much tax do you owe? How much was withheld? So your W-2, especially boxes 1 and 2, they give you the big picture. Now, if you live in a state that has state income taxes, box 17 shows how much total state income tax was withheld by your employer, and that'll transfer to your state return. The final box is box 12. Box 12 isn't anything that you actually have to report on the 1040, but because there's a lot of different moves that you can make to make your tax life better, like making an IRA contribution or having a contribution to a HSA plan, taking a withdrawal on something. There's a lot of different moves that you can make. Box 12 is a box that has letter codes that give you and the IRS a little bit of context as to what's going on. The most common letter codes that you would have, more than likely when you start working, would be code D, which indicates 401k contributions, code E, which is 403b contributions, code W, contributions that are made to an HSA plan. And because the government wants to know how much your healthcare costs, even if you don't pay it. So if you have a boss who pays for your health insurance, code DD is where your employer indicates to you and to the IRS just how much your employer spent on your healthcare benefits. So that, my friends, is Form W-2. And that ties us back into the amount of tax that you're liable for. The second big picture is the amount of tax that you've paid. And this just comes, like we said before, from W-2 withholding or from estimated taxes that you've paid. W-2 withholding goes here. Estimated taxes that you've paid go here. You add them all up and your total payments go there, and then you compare it and you're done. Excuse me. So that, my friends, is the basics of how your W-2 works and how it ties into your tax return. Okay? I want to give you a couple of last minute things because, again, one of our goals is to reduce, eliminate, or defer taxes. So I want to end this lecture with a couple of subtle things that you need to know as we start thinking more about doing a tax return. The first big idea, in tax law, you might be eligible to take tax deductions and tax credits. Now, a lot of people who don't know the specific jargon of taxes, they use these interchangeably. They get them confused. They say, oh, I have a deduction or I have a credit, and they use them sloppily and interchangeably. But that's not really the case. So let's break it down. First, a tax deduction reduces your taxable income on a dollar for dollar basis. Look up here. Let's go to our first page. Let me clean this up here. Make this new. It'll make some more sense for us. Keep it clean. We said that your total income was on box 9. Well, box 10 includes deductions, and box 12 includes deductions. And boxes 10 and 12, these deductions, they reduce, they reduce your taxable income. So what deductions do is reduce your taxable income on a dollar for dollar basis. That's a good thing. Every deduction will reduce your taxable income. With a lower taxable income, you will therefore have a lower tax bill. That's great. On the other hand, we have what are called tax credits. And whereas tax deductions reduce your income, your taxable income on a dollar for dollar basis, tax credits reduce your whole tax liability. If we go back here, let me clean this up. You have up here on line 16 your total tax, and then you have on line 19, excuse me, go to blue, on line 19 and on line, I believe, 20, you have all your credits. Those are then subtracted from line 21. So whereas, again, your tax deductions reduce your taxable income on a dollar for dollar basis, tax credits reduce your tax liability on a dollar for dollar basis. Now, people who don't know the difference would say, oh, they're one and the same, but they're really not. Which one is preferable? The answer is whenever possible, you want to take credits over deductions. You don't have a choice generally, but if you ever have a choice of a credit or a deduction, you take the credit. And let me try to prove that to you with some very simple math. Let's do a simple example. Let's take our friend Tony. Tony makes $75,000 a year. We'll keep this very easy to say that Tony pays a flat 22% tax on his taxable income. Let's say that Tony can either do a $5,000 deduction or a $5,000 credit. Let's figure this out. Let's start off with, in blue, the deduction. So step one, Tony has an income of $75,000. He's going to take a $5,000 deduction. Remember that in economics and accounting and finance, brackets indicate a subtraction. Those deductions then take him down to a $70,000 taxable income. And remember, it's taxable income that is the basis for your tax bill. He's paying a 22% tax rate, so we're going to multiply his taxable income by his 22% rate, and that gives us $15,400, and that's his tax. He has 0 tax credits. I'll be real specific here. He has 0 tax credits, and therefore his total tax is $15,400. Now let's go to red and line by line follow this. Well, his income is still going to be $75,000. But in the case of a tax credit, it's not a deduction. So under the deduction line, it'll be 0. And that takes his taxable income, well, it leaves it at $75,000. Notice again that the difference between this one and this one is the $5,000 deduction, because deductions reduce your taxable income on a dollar for dollar basis. He's going to pay 22% on this. That gives him $16,500. This is his tax. But now he has credits of $5,000. Those credits reduce his tax burden. That's the key. Credits reduce tax burden. Deductions reduce income. Credits reduce tax burden. In this case, when you subtract his credits, his total tax is $11,500. So clearly, it's preferable to take credits over deductions. They're both good, but credits are better. By the way, one little bit of weird tax math for you, if you want to follow this. Notice that if he took the deduction
His tax bill was 15,400. If he took the credit, it was 11,500. The difference there, the delta, is 3,900. Well, notice that his tax burden is 22%. 1 minus 0.22 is 0.78. And the $5,000 in question times the 0.78, that's equal to the difference between those two cases, because that's how the math works out. And anyway, that's credits and deductions. I also want to point out capital gains. Now, a capital gain is a very specific tax term. Capital gains are the profits that are made when you sell an asset. That asset can be your house, stocks, bonds, collectibles, whatever it is. Okay. In other words, when you buy an asset and then you later sell it, the difference between the price you sold it for and the price you paid for it, that's your capital gain. And capital gains critically are considered income. Capital gains are calculated on Schedule D. And look, let's go back here. Line 7, capital gains, attach Schedule D. You put the capital gain amount right there, and that's going to add to your income, okay? So it's important to see that capital gains are considered income. Capital gains can also be considered short-term or long-term. Short-term refers to an asset held for a year or less. Long-term is an asset held for more than a year. Okay, so if you own an asset and you sell it before a year is up, that's a short-term gain. If you wait a year and a day or longer, it's a long-term gain. You ask, what's the difference? Well, here is something very interesting, and it's very rare in tax law. But in this case, there are differences in how short-term and long-term profits are treated. Specifically, the IRS taxes short-term and long-term capital gains differently. Short-term capital gains are treated as regular income, and they are taxed at your normal marginal tax rate. Okay. So whatever tax bracket you're in, let's say that you have a really good year and you make 150,000, that puts you in the 24% bracket. If you sell some stocks or a collectible and you have a capital gain, if it's a short-term capital gain, that capital gain is treated as normal income and it is taxed at your 24% rate. It's not good. It's a lot of money to pay out. But notice this. Long-term capital gains are taxed at a lower rate, a preferential rate. These rates depend on your income, but basically long-term capital gain rates are significantly lower than short-term rates. What's the moral of the story? If you start to build up a portfolio, if you start building up an asset base, and if you have to sell those assets, make sure that you're smart. Don't be a jabroni. Make sure that any capital gains are long-term so that you can benefit from that lower preferential rate, okay? All right. Now, this all seems very complicated, and it is. There's a lot going on here. But the best way to learn it is we're going to do in a separate video, we're just going to do a tax return. So I'm going to introduce you right now to a guy named John Doe. This is all posted. The links are there for you. All the PDFs are there, so you can take a look at this. In a separate video, we'll do this tax return together. But for now, John Doe is this fictitious guy, and I have given him all of these different things. We're going to talk about John's income that he made from his job, his interest income. He had a pension distribution. He had a student loan interest that he paid. He owns a house, which might have some tax benefits. He put money into an IRA. He gave money to charity. So we're going to take this fairly complicated thing of John Doe, and we're going to learn to put it into a real tax return. To do that, let me get back to where we were. I gave you here the first pages. We did this already, page 1 of the 1040 and page 2, but we're also going to look at separate schedules, including Schedule 1, which shows as adjustments, Schedule 2, which shows additional taxes, Schedule A, which shows itemized deductions, and Schedule B, which shows interest and dividends. So we're going to put all of these together, and then from there, you'll have a much better sense of how a tax return actually works. There is one last thing I wanted to show you before we do the John Doe example in our next video, and that is this. Early on in the lecture, when we were talking about this, we were talking about tax brackets. I showed you that tax brackets are like chunks, and each amount of income within that bracket is taxed at that bracket's rate. So when you made $50,000, you had to do 3 different transactions or 3 different calculations and add them up. This is a pain. Fortunately, you don't need to worry about all that, because the reality is the IRS gives you what are known as tax tables. Much like the factor tables provided a shortcut for TVM and the mortgage factor tables provided a shortcut for mortgages, these tax tables provide a shortcut in calculating your total tax burden. We had said a while back that your tax burden is a function of your taxable income and your tax status. Let's just say, hypothetically, that you have a taxable income of $31,100 and you're single. You simply scroll to 31,100. Here's the 31,000 block. 31,000. We said that your income is 31,100, so it's at least 31,100. So that's right there. And we said that you're single, so that's right there. The intersection point of this bracket and this filing status is right there, 3515. In other words, these tax tables, by taking, again, your taxable income and your filing status, these tax tables, they save you having to go through bracket by bracket by bracket, and they just give you the overall number. They do all the hard work for you. And that's what those are. Okay? So that, my friends, is John Doe. And in our next video, we will figure out his tax return. And what we're going to learn in that, and this is our last slide for the day. We had said earlier in the day that you have 3 primary goals in tax planning. You want to either reduce, eliminate, or defer taxes. In the John Doe tax lecture, in the John Doe preparation lecture, we're going to do it and I'll prove it to you. But for now, if you want to do this, you only have a few, excuse me, there's only a few moves that you can do. You can either reduce your gross income, which will reduce your taxable income. You can reduce your taxable income with deductions, which reduces your taxable income, or you can increase your tax credits. I mean, at the core, those are the only primary legal ways to get yourself in a better tax position. Reduce your gross income, use deductions to reduce your taxable income, or use credits to reduce your tax burden. That's broadly speaking what you can do. Specifically, that manifests in these strategies. You can contribute money to retirement plans. This is a huge move, a boss move, and I'll show it to you when we do John Doe. Okay. But if you contribute money to a tax advantage retirement plan, you actually will reduce your taxable income down. Fantastic. You can put money into a traditional or Roth IRA. You can invest in types of investments like municipal bonds, where the money that you earn is tax exempt. Of course, we said that if you're going to have a capital gain, you're going to hold it for a year plus and take advantage of those favorable long-term rates. If by chance you're self-employed, you're going to keep excellent records as to every business expense that you make so that you can claim all those expenses and use those expenses to reduce your business profits. And then finally, 1 through 5, those are all good things that you will do to reduce your taxes. But it goes without saying that you also have to avoid dumb errors. One of the things, and I do taxes, I have a lot of clients. One of the most common issues that my clients have where they owe more taxes in a given year than they have to, it's not because they didn't do these up here. It's because they either didn't understand tax basics, they didn't come and consult with me, but they somehow made a dumb mistake. And when it comes to taxes, even small innocuous errors that you don't even think are major can be really major. Once again, as in all of personal finance, good taxes are about knowing a lot, taking actions, doing the right things well, and avoiding the dumb errors. And with that, have a great afternoon, have a great day, and I'll see you next time when we do a video and we learn step by step how to do John Doe's taxes. Take care.